Hi, I'm Keith McCullough. Welcome to our new studio here in Connecticut. What we're trying to do here today is go through our global macro themes. Now, global macro themes, we do 3 of them every quarter, and what we're trying to do is, number 1, be early, number 2, be not too early, in other words, be right, and number 3, be ahead of consensus. So we're trying to stay on top of the big things that could move your portfolio from a macro perspective. The first big one I really want to talk about is rates rising. Okay, so let's dig into it. Whenever you get a macro call from Hedgeye, we're going to be considering both the long term and the short term and the intermediate term in between. So first, when you talk about rates rising, you have to think about the 10-year bond yield at least going back 50 years. So what you can see here in this chart is, number 1, that the all-time low in the 10-year bond yield was 1.62%. That was in November of last year. Everything was going to end. The world was coming to an end, allegedly. Then you could see on a long-term basis, the average 10-year bond yield rate is 6.57%. So in other words, from a long-term mean reversion perspective, interest rates could go up 300, 400, 500 basis points from here, and that would be considered to a normalized level. So that's point number 1. The Queen Mary is turning, and long-term interest rates are going up. That's the intermediate to long-term call. Now, if you flip forward and look at the immediate term or the intermediate term, we care about both. I think that people who don't end up getting some of their own issues. But if you just look at it for what it is, we use our own model. So this is where our quantitative model comes into play. We look at trades, which are 3 weeks or less. We look at trends, which are 3 months or more. And we look at long-term tails, which are 3 years or less. We don't purport to understand what's going to happen beyond 3 years. But again, these 3 lines, you can see them in this chart. 1.92% is the long-term tail line of support for bond yields. So unless that breaks, I'm going to be bullish on bond yields. And then moreover, the intermediate term trend of 2.09% and then the immediate term trade of 2.33% are still very much bullish and auguring bullishly for bond yields, which is bullish for growth, and it's obviously bearish for bonds. If you want to look at this another way, now a lot of people fearmonger about this. There's a lot of political incentive to do that because keeping Ben Bernanke at zero pays bond managers, gold fund managers, people that want you to believe that the end of the world is coming and ongoing. But the reality is that this has never occurred in U.S. history, at least, and I don't suspect that it will happen this time. So what you can see in this chart is that the 10-year bond yield rates of 4%, 5%, and 6% coincide precisely with strong U.S. growth periods. And you can also see that on this chart. Average GDP is the blue line. So that blue bar is high when interest rates are high. So rising interest rates mean rising growth expectations. For anybody in this country who wants to ever grow again, you should want more of that. Now, during periods of rising interest rates, a lot of people might have to fight that headwind, particularly if they're long bonds. But the reality is that there's 3 big things going on here. Rising bond yields leads to an expanding yield spread. Expanding yield spread, put another way, is how banks start to make more money. They start hiring faster. People start to make more money. It's a good proxy for growth. And then finally, you get U.S. dollar appreciation. Now, a strong dollar rising interest rate environment was 1983 to 89, 1993 to 1999. So you can love Clinton, you can love Reagan, you can love them both, you can love neither. It doesn't matter. The reality is that strong interest rate environments alongside a strong dollar equals strong America. Now, from a sector perspective, now a lot of investors ask me this question. So what do I do in a rising growth expectation environment? Well, it's easy. You buy growth. So again, here you can see the 2 sectors that we really like are consumer discretionary stocks and the financial stocks. What we don't like and what we want to avoid, like the bubonic plague, obviously, is slow growth sectors and or Bernanke bubble sectors. So again, sectors that people chase because they were seeking yield. Whatever they're seeking, they're not going to find it anymore. So again, utilities, we don't like those at all. We don't like basic materials. Now, from a U.S. dollar versus gold perspective, you can see that this is quite interesting. Really, gold, the enemy of gold is growth. Now, again, that's maybe a peculiar way to state it, but it's really a fact. So if you get a rising interest rate environment and a strengthening dollar, what typically happens, and this happened precisely in 1982 and happened throughout the 90s, gold gets smoked. So the last thing that you want to do is buy into a gold mining company that's hinging their hopes on a higher gold price, because we don't think it's going to happen. Now, gold price versus Ben Bernanke. This is the love affair that became a marriage, and now it's in divorce. Now, look at this thing. Obviously, the Fed's balance sheet is Ben Bernanke. So if you expect, like I do, that Ben Bernanke is either done raising or done with anything, tapering, raising, cutting, I think he's done, and done. So he's gone. But the reality is that he's most likely going to taper. Whoever comes after him has to taper. Then they have to raise interest rates. That divorce in gold versus the Fed is going to be ongoing. I think confusion in that market is currently breeding contempt. But again, the long-term message is that interest rates and the dollar are going higher and gold is going lower in the face of that. Now, in terms of levels, you can see this on this chart. And again, it's the trade trend tail process. What we're showing you here are the intermediate and long-term durations, the trend and the tail. And again, to get me out of this, I just have to see gold go above 1536. You know, God help me if it goes above that, but if it doesn't, I think I'm still going to remain the bear who's right on gold, which is, again, gold could go a lot lower. If you step interest rates up on the 10-year bond yield towards that long-term mean, or you get up to 6% on the 10-year bond yield, I mean, the price of gold could be 800 by any understanding. I think most people would consider that a normalized environment too. So again, another topic just to hit on it finally to end this, housing. Now, a lot of people say, okay, interest rates are rising. I need to, sell my house, leave my house, live in a tent. I mean, the reality is that's ridiculous. And it's always ridiculous because what happens when interest rates start to rise is that people start to freak out. So let them freak out. Don't own housing stocks. Just get out of the way for now. But don't mistake this for the long-term demand curve that's associated with what's going on in housing, if I'm right. If the dollar goes higher and interest rates go higher, you have a couple other things going on. U.S. birth rates go up, U.S. household formation goes up. That's a really positive thing within the context of this chart that I'm trying to show you, which is supply is mismatched with demand. Currently, you have supply running at about half of demand. So that's a really good thing for housing, but you got to buy those stocks right. So we don't want you to run into those stocks just yet. We'll be giving you a signal on the real-time alerts product. That's how we get you in and out of things when we're waiting for something like that to give us a signal. It's called rates rising. And I think there's really only three big things to take away from that. Number one, you get out of bonds. That's easy. Number two, you short gold. That might be even easier. That's what's working big time right now. And number three, which is less easy to do or less easy to understand, I think, you buy growth. And if you buy growth, we want you to be buying U.S. stocks, particularly U.S. growth stocks that are either U.S. consumer discretionary stocks or U.S. financial stocks. We have a lot of ideas on that. I'm Keith McCullough. You can find me on Twitter. @Keith McCullough is my handle. And or you can tweet us, and I'd love to hear some questions from you at our new @HedgeEyeTV handle on Twitter as well.